In this video, we're going to have a look at Nestle, the Swiss consumer giant that is mostly known for brands like Nescafe, like their coffee, as well as different chocolate brands like KitKat or Nestle, as well as some additional water brands that are maybe less familiar to most of you, but I think Nestle is very much in the water and beverage business, even all the way I think to their detriment as well, because I do think they have some bad publicity and some bad PR because of I think they're trying to upskill the price of their water in Africa, which of course didn't go well with most people, rightfully so. So Nestle is usually branded as like this evil corporation that tries to make profit wherever they can. So let's see, given that they have this reputation, let's see that it's even accurate. Let's see if Nestle is actually this very big giant corporation that is making money hand over fist every single year. Now, before we look at their financials, I think it's important to note that the numbers displayed here are displayed in Swiss francs, not in euros, not in dollars, in Swiss francs, because of course Nestle is a Swiss company. So looking at the numbers, looking at their top line revenue growth, the total amount of sales that they do make as a company, we see that over the past 10 years they have been very, very stable in their revenue. And I'm saying that like it's a good thing, and it very much is, but it also means that the growth here is very, very limited. Now, mostly for companies like Nestle or Procter & Gamble or Unilever, they have to increase their revenue by acquiring additional brands, by acquiring additional market share, because most of the time the products that they do have are already like in a mature stage. I think everyone knows of brands like KitKat nowadays, and it's not really like they're going to break the market because they're already very much a mature product within the market. So if a company like Nestle wants to increase their revenue and increase their earnings, they're going to have to acquire additional brands. Now, of course, Nestle does this from time to time. They acquire brands and they dispose brands. They also invest into different companies. I think Nestle actually has a 20% stake in the French beauty giant of L'Oreal. So this is how they make some additional revenue. But just looking at their revenue over the past 10 years, we can see it's relatively flat. And that brings us to EBITDA, earnings before interest, depreciation, taxes, and amortization. It is the bottom line earnings for a company like Nestle. And what we see here is that quite similar to their revenue is that numbers have been relatively stale. They do see some growth in their earnings growth, about 0.7% year over year. But I think it's important to keep in mind that on average, inflation rises about 2% a year. So the fact that they're able to increase their earnings by 0.7% is really not that promising a number. So I do think this means that their earnings are actually increasing faster than the revenue is, or it's increasing faster than the revenue is for sure, because the revenue is declining, which means that they have been able to increase their profit margins as a company, which is kind of what you expect with a company as mature and long established as Nestle is. But these numbers are really not all that big, and so yeah, I think the first numbers here of revenue and earnings are not as promising as maybe I would have liked. Now this brings us to debt. We can see that debt level has been increasing for the past 10 years by about 16 to 17% a year. Still the nowhere near scary level, so I'm going to go ahead and give them a pass on this. Excess cash on hand, not much to say there. Market cap, on average their market cap has been growing by 7.3% a year. Now this is purely the market cap as is seen on the stock market itself. It is the full share price of the company. So this does not include any dividends that's being paid out, because of course you get that on top of the appreciation in share price. So this brings us to enterprise value. Now enterprise value is the full market cap to which we add the debt and subtract the cash. It's the entire value of the business, and we can see here that it's been growing relatively in line with market cap. Of course the debt has been growing relatively fast for the past, well, let's say 4 or 5 years. So the enterprise value has been rising a bit faster than the market cap has. Looking at their EV to EBITDA ratio, this is really the multiple that we tend to use whenever we want to value a company, whenever we want to value future projections for a company. And what we can see here with Nestle is that they have been on average about 15.3 times earnings. So this means it takes Nestle about 15.3 times on average of earnings to pay down the entirety of their company, the entire enterprise value. Now, I think what we do see here is that initially in 2012, 2013, this multiple has been relatively low compared to the average 11 to 13 times, and in the past 3 years it's been actually quite high, 21 times, almost 22 times here in 2021, which is an insane valuation. I think it's way overpriced, especially considering that Nestle, even though it's a very established brand and their revenue and earnings are very, very solid, they do not really show any growth prospect. So I think to attach a multiple like 22 times to a company that isn't really growing is really, in my books, a indication that a price may be overvalued. But we'll get to that in a little bit when we do our projections out into the future. Looking at net debt to EBITDA ratio, like I mentioned, is not really that scary yet. I always try to look at a company that has a net debt to EBITDA ratio of less than 3 times, because after 3 times, whenever they want to issue more debt, whenever they want to take out additional loans from a bank, the bank starts to charge additional interest rate, because at that moment they already have so much debt on the balance sheet that is more risky for the bank to loan them this money. So 3 times is really the cutoff point that I have for any company, and I think Nestle is very much keeping in line with that. They have a relatively low debt level. So this brings us to cash flow, the pure cash money that Nestle has been making. And I think what we can see here is a very steady downward trend here for Nestle when it comes to their cash flow from operations. Now, cash flow from operations is all the money that they make simply from running their business. All the material prices are included, all the wages, all the leases, everything that you need to keep running the business is included in this. And this is the money that is available at the end of the fiscal year. And we can see on average it started with 15 billion in 2012 and has reduced to just shy of 14 billion here in 2021, on average decreasing by 1% a year. Again, not a pretty sight. This brings us to capital expenditure. Now, capital expenditure is every additional cost that Nestle has to do to keep on future-proofing their business. These are all the additional warehouses that maybe Nestle has to purchase in the future, lease in the future, the additional trucks that they have to buy or rent to keep shipping all their goods, a new brush of paint for their main headquarters, anything that you need to keep future-proofing their business, as well, of course, like operating machinery whenever that needs to be replaced. It's also a part of capital expenditure. Capital expenditure is very much the investment that a company has to make for the future to make sure that they are future-proofing themselves and can keep operating many years to come. And what we can see here is that their capital expenditure has actually been decreasing in line with their cash flow from operations. So I think that's very much a good thing. I like to see them reduce their spending, but of course not to the detriment of their cash flow. So still, even though I do like that capex is coming down, I do not like the overall trend that I'm seeing here. So this brings me to free cash flow. This is all the money that is available to you as the shareholder at the end of the fiscal year. After Nestle has done everything to keep operating their business, to keep future-proofing their business, this is all the money that's available in their vault to be divvied out to investors, or to buy back shares, or to make additional investments to really increase the future cash flow, or pay down their debt levels. And what we can see here, just in line with the other things, is that their free cash flow has been on a decreasing spiral for the past 10 years, hitting a record low here of 9 billion in 2021. So a bit of a scary thing here again, I do have to say. But let's move on, because the very positive thing that Nestle has been doing, and they've been doing this consistently, is buy back their shares. They have been buying back shares like crazy. Every single year, they reduce their total share count by 1%, which is actually ridiculous. So this makes this is a big reason, I think, why their price has been going up so much, is because they're simply taking shares out of circulation. About 3.2 billion shares in 2012, and they reduced it to just shy of 2.8 billion in 2021. So they took about 400 million shares out of circulation. Free cash flow per share is what you get when you take the free cash flow and divide it by the amount of shares outstanding. Now, this is very much how Nestle has been trying to increase or seemingly increase their numbers, because even though their free cash flow has been decreasing, they have been decreasing their shares a bit faster than I think free cash flow has. So this is how they're able to increase their earnings per share because simply they take shares out of circulation, which means there's more earnings attributed to one particular share, and this is how they are able to sort of artificially, but not really, it's a bit of an accounting gimmick, but to increase their free cash flow per share, even though their free cash flow is very much decreasing. So yeah, on average over a 10-year period we see a 0% increase on average, but they definitely had some better years here, like in 2009 where they booked a profit of about $4.15. Sorry, Swiss francs. I do still have the dollar signs here, but of course everything here is in Swiss francs. Price per share, we can see the price per share has been increasing by 9% annually. I think this is a very, very big, high and strong growth for a company that has not been growing for the past 10 years, but I think it's mainly because they have been taking shares out of circulation. Free cash flow yield is on average 3.9%. Over the past 2 years here, 3.5, 2.5, which are record low numbers, which again goes in line with their very high multiple here in 2021, which I think is a moment where they would definitely overprice 128 francs with a free cash flow yield of 2.5%, which is insanely low for a low growth company like Nestle. Okay, so we had a look at their earnings, we had a look at their cash flow. Let's see if we can forecast this business into the future. Let's see if we can make a projection and estimate where Nestle is going to be 10 years from now. Now, whenever I make a projection, I always want it to be as conservative as possible. And when a conservative estimate beats the stock market, that's when I'm going to be interested in buying the stock and holding it for the coming decade. So looking at that average earnings growth, we can see that they've been growing by about 1% a year. So I'm going to give them this 1% growth from the 2021 numbers onwards and say they're going to keep growing by 1% for the upcoming 10 years, which is still very much underperforming inflation, and I think it's a very low growth rate, but I do think it's accurate given their history. I'm going to give them a 14 times multiple. Now historically they've been at 15.3. And especially the past 3 years have been exceptionally high, and I think this is going to come down. I think if I'm looking for an accurate EV/EBITDA ratio, I'm thinking of 14, maybe even 13 times to be very conservative, but I'm going to give them 14 times because I want to take this margin of error. I want to have an additional cushion to save me in case something goes wrong with the share price. So this gives me an enterprise value of 277 billion, to which we subtract the debt as the cash, gives me a market cap of just shy of 250 billion, divided by the amount of shares outstanding. I'm going to assume that their share count stays the same, even though I'm very sure that they will keep on buying back shares and the total amount of shares outstanding will decrease over time. I'm going to keep this number the same as in 2021 because again I want to cushion my blow, and I do give them a 1% earnings growth, even though historically they've been doing 0.7%. So I think this kind of makes up for it, and I think there's more than makes up for it, and I'm just going to leave this here. So this gives me a stock price 10 years from now for Nestle of 88 francs and 88 cents. Franc cents? I'm not sure. 88 cents. It's a very pretty number, I do have to say, but it's not a high number. So this brings me to free cash flow. On average, like I mentioned, they have been quite stable with their free cash flow. But because they've been able to buy back shares, I do think they might be able to grow their free cash flow. Like we see here in 2012, they had 3 francs and 26 cents. And in 2021, they had 3 francs and 22 cents. But in between that, they definitely had some higher numbers here. So I think $3, 3 francs 22 is definitely towards the low end, so I think they will be able to increase this annually by about 1% a year. Free cash flow yield, on average they've been at 3.9%, which I think, if we take into consideration the last 2 years, which I think have been abundantly low, I do think their free cash flow yield is going to come up, because I think this is very much an overpriced territory here, and I think 5% is a pretty nice and conservative percentage to give to Nestle. It's a similar number here to 2016 and all the years prior to that. So I'm going to go ahead and give them a 5% yield, which gives me a stock price 10 years from now of 71 francs and 19 cents. So right now on the market I can buy as many shares as I want for 109 francs and 48 cents. If I take both my projections into the future of my enterprise value as well as my free cash flow, I get an average share price of 80 francs and 3 cents, which is very much a lot lower than the share price currently is. So simply looking at this projection, on average, I think if you buy the shares now and hold it for a decade, on average, you'll lose 3% of your value a year simply from looking at the stock price in the stock market. Now, of course, Nestle has very much been cash flow positive for the past 10 years, and I'm assuming they will continue to be so in the upcoming future, given just how many brands they have, given how mature they are, given how well positioned they are in many of their operating fields. Of course, this cash flow will be handed out to you as an investor. You are a shareholder, and of course, as a shareholder, you get the benefits of taking a hold of their free cash flow, which they will mostly use and reward you with by reducing their share count. Now, if we take this free cash flow into consideration, I think on average the internal rate of return for Nestle is 0.5% a year. Now, I always say on average the stock market returns about 10% a year, so I think Nestle is very much underperforming that number by a long shot. They really are. I think Nestle, even though the price has been coming down from let's see, 128 here in 2021 to 109 here in 2023, I still think that 109 francs is a very overpriced for this stock. They do not have a good growth prospect. They are very established, but their revenue and their earnings have not been growing. I do not think this stock warrants a valuation that it currently has, and I think it's going to come down into the future. Now, of course, it does have to be noted that Nestle is a very stable company, and there's no risk of bankruptcy or anything like that, but still, I do not think it's a good investment vehicle for me right now. But let's have a look here what happens if the stock price comes down. Let's see what needs to happen before I say that this valuation is attractive. So currently the price is 109 francs, which gives me a 0.5% IRR. Now if the price comes down by about 30% to 78 francs and 83 cents, it gives me an IRR of 5%. So even if the stock price comes down 30% from its current number, I still very much will not be interested in buying this stock. Now, of course, this is not financial advice. You can feel free to make your own decisions. And if you think that Nestle is a good company, or you very much like their brands and you want to be a part of it, of course, by all means, do invest in this company. But I, for one, will not be looking at Nestle anywhere in the coming future until the price comes down to about, I'm assuming, the 50 euros range. So that was it for this video. That was it for Nestle. Thank you very much for watching the video. Don't forget to like, subscribe, and all that good stuff. And I'll see you in the next one. Cheerio.